Now, before we get into this, we'd like to remind you, please like, share, subscribe. Your support is appreciated. So we talked about this on the EIA show. And we want to marry this back with segment one. When you look at the slowdowns that we've seen across 50 some odd countries, and then the activities that we haven't seen happen in the US. And this is just looking at Google search data, because we're looking at the rolling 5-week change in Google search trends. And we just want to call the attention to the summer, as we look from May 1st to July 1st, and where we were on May 1st to July 1st on 2020. And you can see the shift. That's flying, that's hotels, job interviews, commuting, restaurants, movie theaters. A lot of that has slowed, and it's not. There's a mixture of, well, people already purchased it because they had the opportunity to, because there was a ton of deals between, let's call it the end of March to the end of April. So if you've already booked your trip for July, why are you looking again? Or if you've already booked your trip for August, you don't need to look again. So there's a mixture of that within there, but you can also see that it's maintained some of that on the previous year in terms of some of that activity, which is why, again, we keep talking about how we're going to plateau at a fairly stable level here as we see some of this adjusting over time. So again, this is something that gives us pause when we look at activity within the U.S. and just what is that turnaround going to look like as we start talking about price increases, and how the consumer can sit there and say, look, I'm not paying this price right now. I'm going to wait. I'm going to wait for prices to come down a bit. And those are some of those pressure points. But the issue right now is small businesses being open. So when we look at all businesses, leisure versus hospitality, you're seeing that steady decline in terms of the recovery as some pressure continues to fall, and businesses just go out of business. And this is where some businesses try to survive. They try to get to the other side. They finally get there and they realize they just don't have enough, and they're going to have to shut down. And you're seeing that actually increase as we get into July. And it's more because it's, when is your debt due? When are you expecting? What was your longevity? And then finally the people to say, look, it isn't enough. And it's at the leisure and hospitality side. So when you look at jobs, you may see some jobs are available, but how many of these small businesses are opening versus closing? And this is putting some additional capacity into the market and taking some of those potential jobs out as businesses kind of struggle to see that reopening. And if you're not reopening, you're not expanding. And then it's going to take time, because, say, for an example, you have 3 competing stores on one block. 2 out of 3 of them go bankrupt. And you see that as the owner of the last open store. So you're like, all right, well, I should pick up some of their business. I won't pick up all of it because they might have changed spending patterns, but I'll pick up some of it. And I'll probably have to hire people, but I'm going to want to see that come through. I'm not going to try to jump in front of that, given my balance sheet's probably already stressed. I'm not sure if I have the inventory yet, and I'm already charging higher prices because my rent went up. I had to give some, my inventory's gone up in price. So these are things that, again, are weighing on some of that capacity of reopenings, closures, and job front. So then when we look at the inflation surprise index, it's important to look at the fact that inflation continues to surprise to the upside. This will start to pare down. Now, as I've been saying, we're going to go from inflation to stagflation, because when you look at some of the drivers, used cars aren't going to continue to go up in price. They don't have to come down that much, but they're at all-time highs. Where are they going to continue to go? You look at big durable goods. When you think about people who move, how many refrigerators and stoves and couches are you really going to buy? So there's a certain amount of that's going to come out. But then when you look at CPI's calculation on housing, when you look at wages, when you look at supply chain pressure, when you look at gasoline, diesel, all of these things continue to go higher. So even though you're going to get some rollover on one front, you're getting increases on another. They're not one for one. So you will see it come down. It's just going to remain elevated because you will see that price increase on the other side. And this is just looking at an example of average hourly earnings by industry. So ranked by percent change, 3-month annualized. So over the last 3 months, this is what we've seen. And then obviously if you take it on an annual level, so transportation and warehousing, earnings are up 17%, leisure and hospitality 15%, retail 9%, other services 7.5%. So again, these are wages that need to be passed through because you're paying them more an hour, and you have to, how much of that can you eat yourself? How much margin do you have available, and how much can you pass through? Which is just showing just where that pressure is overall. So then when we look at change from a year earlier, when you look at just, weekly earnings and inflation, this is looking at it a little bit differently, because you're seeing this in terms of change from a year earlier, where that was 3 months. So over the last 3 months, you've seen that change. And then when you look at the year over year, you can see that we're actually getting some of these increases as some of that normalized into the back half of 2020 as new employees as furloughed employees came back. That's where we continue to see all private workers and the pressure continuing to the upside, not just because it's a year over year and there's base effect, but when we look at the last 3 months, in order to get people to come back to work, you're starting to see that press higher. But when we look at the broad market recovery, and I think this is an important chart to look at to see where is that shift, because wage growth still is very slow when we look at June 2021. So when you look at where we were in Feb and where we are now, wage growth continues to be lackluster. Long-term unemployment continues to be elevated. Initial claims have gotten better, but they've stagnated now. Job openings obviously are near record rates. So the issue remains on the wage side, because so if you look at this chart, the whole left side looks like somebody just slammed it in and just smashed it to the center, and we're not seeing that really bounce back, and it's taking a lot of time because there's I don't know, for those that saw, there was a judge that said states had to accept the national, or I should say the federal extension of unemployment benefits, which were set to expire nationally in September. And you remember how we talked about some states opted to exit it early. They are saying, he is saying that was not allowed. So that will go back and forth in court. But again, this is something that could put more pressure in terms of employment, because, is it worth getting paid $19 an hour if I can collect 18 sitting at home? And this is some of those pressure points. But wage growth is the one that is struggling, because we're seeing wage growth, but we're seeing it at the lowest level. So even though we're seeing people come back, it's at the low income level. So the incremental increases are smaller on a percentage basis. There's more of them, so it's actually decreasing what wage growth would look like. So there's also some skew in the way it's calculated, but net, this is a problem area, and especially the low skill wage growth, because we're starting, that's what I'm saying, we're starting to see that grow a little bit, but we're not seeing it come back to the way it should as long-term unemployment remains elevated. And this is just looking at it a little bit differently, because fewer workers are coming off unemployment than normally would, given the amount of job openings. Now, you can see just how extended this is going back through June. So June 2021 transition rate, 12.2% below expectations, 1.1 million fewer unemployed people than should be based on the amount of jobs that are available. Why? Wrong skill set, not willing to, so wrong skill set, unemployment benefits good enough, and then just how long does it take to get employed? And if you look at interviews and structure and all of this, the employees, there's a ton of jobs, I'm going to be picky, and then the companies are like, there's a ton of unemployed, I'm going to be picky. So there's also that disconnect, which is showing up in that skill set breakdown, which we've talked about. And I think this just puts it into perspective, and is a very good chart in explaining where some of those overhangs are, and just how the disconnect remains and is getting worse and you can point to unemployment benefits and some of these other components that can remain a headwind. So then when we look at U.S. current median, in wage and salary, so this is where wages and salary are. as we've been talking about, pulling things higher. And this is where, when you look at where median CPI is, which is, again, another component to it, why we think the CPI is going to pull higher, again, inflation in general. So employment level, part-time for economic reasons, has fallen, because why am I going to hire a new employee when I have a part-time employee I can make full-time? And this is where I think the disconnect is, because let's use the store example. Two stores, there's 3 stores on a block, 2 of them go bankrupt or close, and I'm the last one standing. I have 3 employees that are part-time, 1 full-time. Well, if I know one of them wants to be full-time, why hire someone new for an extra part-time position? I'll just promote them to full-time. And this is where you're starting to also see some of those overhangs, where do more with less. Where in the past, I would have hired an extra person. Instead, I just give one person additional hours and try to work with what I have. Now, this is the biggest misnomer that we continue to see, and it's the excess savings have nearly reached 2.6 trillion. So this is what everyone likes to point to when they say, oh, look at how rich everyone is. Look at all of these trillions that are going to get dumped back into the market. Well, we have to think about, where do those excess amount sit? So now then you look at it from a country perspective. So from a country perspective, everyone's like, oh, look at all these excess savings as a percentage of GDP. Everybody's going to start spending. All this money is going to come back into the market. But where does it sit? And that's where I said it. I used it twice last week. I'm going to use it again this week. Where the money sits is grossly misstated and used as a coverall, because when you look at it, it is all weighted to the top. Now, how much more are these individuals going to spend? They already spend the most when you look at the consumer side, and they aren't the ones that are struggling. It's these bottom quintiles that are the ones that are struggling. And you can see all of that money has been levered to the top. So you could say the 2.6 trillion sitting at this middle ground is going to come back into the market. But when you look at pricing and just how inflation is hitting them, and I'm not talking about the couch, I'm talking about the things they buy every day in terms of eggs, and when we look at eggs, milk, and Procter and Gamble goods, deodorants, shampoos, things of that nature. This is where some of that money is going to go into, and then others are just going to look to save to try to replenish and try to get out of some of the credit card debt, because we have seen credit card debt fall. And just to put it into perspective, U.S. households added $13.5 trillion in wealth last year, largest increase going back 3 decades. Yet greater than 70% of increase went to top 20% of income earners. 1/3 went to the top 1%. So when you look at the amount of excess savings have nearly reached 2.6 trillion, you have to look at monthly savings and where they have gone into, and they're starting to roll back over, and they've started to come back into the market, just given that government transfers have slowed. We will start to get the child transfers, but that's going to be slow to come as well. So then when we look at solid job growth across wage cohorts, this is looking at those low wage. The one that continues to be very slow is that high and middle, specifically middle, where the low wage continues to go higher. But this is where we get some of that disconnect with the way that the data is calculated, because more hours at a lower wage takes some of those numbers down, even though technically more people are actually coming back to the office, or should say coming back to work. As what makes me think of the office is this next slide, looking at working from home. So this is just looking at the amount of people working from home and how it's fairly sticky on this level of office and administration on up. Now, education will start to come down as people come back to schools and teachers come back to teach in person. But some of these will remain essentially, especially legal. If you think about, do I really need to be in an office to read and write a contract? Computer, mathematics, a lot of these things will stay sticky. But when we're thinking about flex schedule, we think the flex schedule makes more sense in that work from home fully will be 15%, where we'll see about 25% staying within that flex world. So when we look at the average production wages in bars and restaurants, this is, again, leading to where we're seeing those increase in prices. We're seeing restaurants get more expensive, bars get more expensive, prices are going up because they're trying to pass on really a lot of these additional costs. But while all of this is happening, when we look at what has happened so far going to the non-farm payroll, the ISM manufacturing employment has actually come down. When you look at where the ISM employment is, it's actually in contractionary territory. It's not hiring, even though non-farm payrolls have gone up. So this is where we start to look at some of the disconnect. And we expect that the non-farm payrolls to start to increase, but you have assembly lines that have had to slow because of shortages of supply, which is creating some of this disconnect because people have had to go back on furlough. But when you look at just in terms of total non-farm job openings, you can just see just the level of hires and what is available in the market right now. And it's, again, going back to 2001, it's essentially saying that there's more than one job per person, and which is why there's more to it than just people not wanting to go back. And it's that the pickiness in terms of what the job do they want, what person do they want, and what that labor looks like, and what price will it be at. As we've seen here, some of this slowdown in terms of total claims, where total claims have missed estimates. Now sitting at the 300,000 plus, between 300 and 400,000, but we're just not seeing that decline further because it's remaining elevated, and the initial claims, as some people get furloughed again because of those slowdowns and some of that stickiness, which is where when we turn to the continued weeks, you can see that we've had the declines in the pandemic emergency. The question is going to be going forward, how much of this reverses as we have some of this additional capacity come back in, as states may be forced to go back and to go back onto those the extended benefits, as regular states continue to see some of the steady increase of initial benefits. Now, this is looking at the non-farm payrolls that we talked about. 850,000 were added. You can see that, again, that steady climb higher, but the pre-COVID path is getting, if you think about the acceleration, that's just showing something pretty steady, where you had non-farm payroll employment going up in terms of that pre-COVID path, and we're just not getting that acceleration to the upside as we see some additional pressure in July, which should alleviate in August, but there's going to be some of this breakdown in terms of where some of those jobs are. So then when we look at temporary layoffs and permanent job losses continuing to fall, slight downticks, but still trending in the right direction. Still a lot of volatility in average hourly earnings, which spiked 3.6% year over year versus 1.9% in the prior month. So this is where U.S. employment permanent job loss are stopping. Temporary layoffs are still going down, but they're starting to level off, coming back to the issues that we've talked about with supply chains. So then when we look at headline payroll gains, so where were they? And it's not surprising, they were in leisure and hospitality. They were in state and local. The leisure and hospitality, we continue to see that grind higher. It's almost $1.50 more per hour just to get people to come back into the restaurant, and again, cover some of the additional growth. And you're asking them to do a bit more with less, so that's where you're seeing that compensation. And then when you look at the payrolls in general, you're just looking at where things are overall. When you look at U.S. employees on non-farm payrolls, and just you see how that slack remains on the holistic number of only 145.8 million. But an increase in the number of individuals unemployed for greater than 27 weeks, they make up 42.1% of total unemployed. So we're just, you're still seeing some of that stickiness. And now with some of the extension of capacity, does that mean that you get people sitting at home longer? So then when you look at the no change in labor force participation rate ticked up for men and was unchanged for women. So you're just looking at where some of the changes are. As people feel a bit better about getting jobs, you'll typically start to see some people come back into the market. Participation rate ticks up a bit. Unemployment rate goes up a bit because now they're counted again. And those are some of the cycles that we have to look for. And then the U.S. employees on non-farm payrolls, leisure and hospitality. This is being the biggest driver. With lowest average wages has added 1.6 million jobs, which is why they're the biggest addition, but the lowest wage. And again, that's skewing some of the data sets in general when we start looking at what comes next. And that's where some of these wages going up, they'll get passed through, they'll get married into it. And that's where you're going to see some of these costs continue to grind higher. As assembly lines, they have to cover some of those workers, as we talk about Procter & Gamble. Not to pick on just them, because everyone else has said the same. These prices are going to become fairly sticky and be an overhang for the everyday American versus just one side or the other, which is why some of those excess savings will get drained out fairly quickly and not really go into new spending, but just to cover what we need to survive. So those are some of the impacts. And now in the next segment, we're going to look more at bank lending and what's happening going forward, and rolling that into housing and how things have changed over the last few months.